On YouTube, we often tend to hear about the same old stocks. It's always Realty Income, Procter & Gamble, SCHD, all the popular ones. Don't get me wrong, it's not that these aren't great stocks and ETFs to invest in. They are, and I certainly talk about them a fair share myself. But there's some other extremely underrated stocks out there that also deserve the spotlight, and we'll be going through 3 of them in this video. Also, I want to give a quick shout out to today's video sponsor, Countably, but we'll talk more about that later. Now, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, let me know in the comments below, which dividend stocks do you think are the most underrated and deserve some more recognition? I'd be curious to hear what you think is looking good. The first one on my list is Tractor Supply Company, TSCO, which is a retail chain that specializes in products for a more country lifestyle, and they sell things like agricultural equipment, home improvement products, lawn and garden products, and pet care products, and they're outperforming the market by a long shot. Comparing this company's total return against the 3 major indices, we can see that in the last year, it is just blowing them out of the water, where it's up 10.3%. Now, if we zoom out across a longer period of time, across the last 3 years, we're gonna see a similar trend. Tractor Supply is up over 150%. Guys, the 3 major indices here aren't even coming close to that, so it's absolutely dominating. And then if we zoom out across the last 5 years, look at that, guys. A 280% return for Tractor Supply, and the 3 major indices aren't even breaking a 100% total return in this time period. Just crazy. And as I'm sure you can imagine, with this aggressive run up in share price, it's not going to leave Tractor Supply at the biggest discount. In fact, the valuation on this company right now is looking a bit frothy. Looking at their PE ratio here on the valuation page, it's sitting at 22.66, which in its own right is pretty high. This is also about 55% higher than the sector median and nearly 5% higher than the company's 5-year average PE ratio. So this isn't too great, and in just a moment, we're going to look at Tractor Supply's intrinsic valuation to see just how overvalued it really is. But first, we're going to look at their dividend stats, guys. Here we can see their starting yield's not the highest, under 2%, which isn't great, but this payout ratio is super low, which means there is room to continue growing this dividend, and they have done so at a pretty aggressive rate. In the last 5 years, they've grown this dividend on average by 28.5% per year, and they've been growing this dividend for the last 12 straight years, so some nice consistency in the growth department. Now, jumping over to my stock analyzer tool, which you guys will have seen in my last video if you check that out, but if not, this is a spreadsheet that I've been working on. It's still a work in progress, and it's going to show us some of the financial highlights for this company, like the revenue growth, free cash flow, earnings growth, dividends, shares outstanding, and we can even use this to calculate an intrinsic value to see what might be an appropriate price to buy Tractor Supply at. But just starting with some of the financial highlights, guys, their revenue growth is very solid across these last 10 years. In fact, across this 10-year period, they've grown their revenue every single year by nearly 12% on average. Now, for their earnings per share, we're going to see a very similar trend. These charts look pretty much identical, and across the last 10 years, they've grown their earnings per share on average by about 18% per year. Their free cash flow growth is also looking very solid, guys. It looks like 2019 to 2020 was a huge jump, but even without 2020, this is still trending upward. And across the last 10 years, on average, their free cash flow per share has grown by about 25%, which is fantastic news for us dividend investors. So with the financial metrics looking that good for this company, it's probably no surprise that the share price has run up so much. But now let's do a couple intrinsic value calculations to determine what share price you should be buying Tractor Supply at today. The first calculation we're going to do is a discounted cash flow calculation, which is a way to determine how much a company is worth today based on how much money we expect it will make in the future. Now, as we established a moment ago, across the last 10 years, this company has done a great job of growing their free cash flow. The average growth rate is about 25%, but in our calculation here, we're going to be a bit more conservative and say that moving forward, they're probably not going to be able to keep this level of free cash flow growth up. Maybe they're only going to be able to grow it by 15% per year on average. And doing this and applying an 8% margin of safety, which is the discount rate right here, it tells us that Tractor Supply's intrinsic value is about $199 per share, which means it's still about 19.5% overvalued compared to its current share price of about $238 per share. Now, just for fun, if we change the free cash flow growth rate used in our calculation and put it right where the average is, guys, it's going to give us a different number, and it's actually going to say that Tractor Supply is about 45% undervalued with an intrinsic value of $430 per share. Personally, though, I feel better being more conservative, so we'll leave it here at 15%. The next valuation metric we're going to look at is a multiples valuation model, which is another type of calculation that compares a company to some others to see what it might be worth. Basically, we're going to be comparing the PE ratios of some similar companies here. We've got Dick's Sporting Goods, Home Depot, and Johnson Outdoors Inc. And we're going to take the average of these PE ratios, which is about 16, multiply that by Tractor Supply's earnings per share, and that will tell us that Tractor Supply has an intrinsic value of about $155. Now, based on all of this right here, that would mean that Tractor Supply is still 53% overvalued, so it's definitely far outside of buying range just based on this calculation. Now, if we go back over to the snapshot page, guys, we're going to take the average of these two valuation calculations and apply a 10% margin of safety, and that's going to tell us that Tractor Supply's intrinsic value is about $160 per share, which would make it about 33% overvalued compared to its current share price, which is no surprise. I mean, we've seen how this share price has run up across the last handful of years, and if we look at this 52-week range, it's sitting up here at the high end, right towards the top of its 52-week high. So it's no surprise that this company has a lot of room to come down before we would consider it to be at an attractive valuation. All right, now moving on to the second company that I think is extremely underrated, and you don't hear people talking about this one that much. It's Intuit, which is a software company that makes widely used products like QuickBooks, MailChimp, and TurboTax, the OG DIY tax software. And on that note, if you're not a big TurboTax person and prefer not to do your own taxes, then listen up because you're going to want to hear about today's video sponsor, Countably. As you know, we are knee-deep in tax season, which is no fun for anyone and can be a stressful time of year for many individuals who, including myself, are afraid that we'll either pay too much to the IRS or not pay enough, which can definitely land us in some trouble. And unfortunately, as investors, we are responsible for paying taxes on the capital gains and income we receive, which can be a tricky thing to figure out and is something that actually deters people from investing in the first place because they're afraid of having to pay those extra taxes, but this is where Countably's got you covered. As a veteran-owned company with over 20 years of tax experience, Countably specializes in helping investors create customized tax plans to minimize their tax liability and maximize their earnings. They offer a wide range of services including tax planning, which can help you make strategic decisions about your finances with the goal of minimizing your tax liability. They also do tax preparation so they can help you organize and file your tax returns. And for you business owners, they also offer tax advising and bookkeeping services so you can keep better track of your financial records, which can make tax preparation and compliance much easier and less time consuming. If you want to book a tax strategy consultation with Countably, which includes a tax review of your previous year, advisory on your current tax situation, a huge $80 discount on your tax filing, and a free ebook on tax reductions with real estate, then go to countably.com or book your consultation call using the link in the description of this video. Guys, this world is chaotic enough. Let taxes be one less thing you have to worry about and book your consultation call today at countably.com. Now getting back to Intuit, much like Tractor Supply, this company is outperforming the market. Not in the last year though. In the last year, Intuit is down nearly 20% and the other three major indices have performed better. However, things start to look different for Intuit if we zoom out across the last 3 years where they're up over 40% and are beating the three major indices, and the same is true across the last 5 years where Intuit is up over 150%, which is definitely dominating these three indices. Now looking at their valuation, I'll admit guys, on the surface it's not great. Their PE ratio is about 31, which is 50% higher than the sector median, but this is also about 21% lower than the company's 5-year average, which is a good sign, and the company is also experiencing a lot of financial growth, which we'll take a look at in a moment, so a higher PE ratio really isn't that surprising. But first, taking a quick look at their dividend stats, the forward yield is really nothing crazy guys, 0.74%, so it's pretty low, but these other three stats here are looking great. Payout ratio is only 23.5%, a lot of room to keep growing that dividend, and they've done this at a pretty aggressive clip too, near 15% across the last 5 years, and they have a nice dividend growth history of 10 straight years, so there is some consistency here. Now back over on the stock analyzer tool, looking at some of their financial highlights, this revenue growth is off the charts guys, and in the last 10 years they've been able to grow their revenue by an average rate of about 12.3%. Their earnings growth is looking fantastic too. It looks like 2015 was a rough year, but everything else it's been pretty aggressive growth, and on average across the last 10 years their earnings per share has grown by over 22%. And looking at their free cash flow, look at this guys, very aggressive growth, and this has grown by almost 16% on average across the last 10 years. And now looking at the discounted cash flow calculation for Intuit guys, they've grown their free cash flow by, like we said, nearly 16% across the last 10 years. We're going to be a bit more conservative and say moving forward they're only going to grow this by 12%, and with an 8% margin of safety this gives us an intrinsic value of about $462 per share, which means it's about 9% undervalued compared to its current share price. Not too bad. And now looking at the multiples valuation model comparing Intuit to SAP, Adobe, and Synopsys, the average PE ratio across these three companies is about 51, which when we multiply that by Intuit's earnings per share, that gives us an intrinsic value of about $377 per share, which makes it about 11.5% overvalued compared to its current share price. So that's not too great. Now, if we take the average of these two valuation calculations and apply a 10% margin of safety, this tells us that overall, Intuit has an intrinsic value of about $378 per share, which makes it just a little bit overvalued by 10%. And now guys, moving on to the third and final company, this one is FASTENAL, which is a company that distributes industrial and construction supplies with a primary focus on fasteners, and they offer a wide range of products and services including safety equipment, tools, and inventory management. Now much like the first two companies, FASTENAL is outperforming the market. In the last year, they're up about 4% where the rest of the market has been down. If we look at the last 3 years, FASTENAL has seen a a total return of near 50%, which is beating the rest of the market by quite a bit. And now zooming out across the last 5 years, FASTENAL is up about 120.5%, which is basically doubling the returns of the rest of the market. And also, like the last two companies, the valuation doesn't appear to be too great. I mean, their PE ratio is 26.86, which is over 50% higher than the sector median and is right in line with their 5-year average. But stay tuned, guys, because in just a moment, we're gonna do an intrinsic value calculation for FASTENAL, and I think you'll be pleasantly surprised. Before we get to that though, looking at the dividend stats, the forward yield is gonna be the highest that we've seen all day, 2.65% with a higher payout ratio, 65%, and their 5-year growth rate is off the charts, 14%, and they are almost a dividend aristocrat with 24 years of dividend growth. Now looking at some of the highlights here, guys, their revenue, just like the last two companies, straight up into the right, and this is growing by about 8.5% on average for the last 10 years. Their earnings per share growth is looking fantastic, guys, very similar trend, and this is growing by about 10.6% on average for the same time period. FASTENAL's free cash flow growth is looking fantastic. I dare you to try and say that 10 times fast. And across the last 10 years, this has grown by an average rate of about 15.5%, so very nice. Now getting into the discounted cash flow calculation, guys, once again, we are gonna be conservative with our estimation here and say moving forward, they're only gonna be able to grow their cash flow by about 10% on average. And applying an 8% margin of safety, this gives us an intrinsic value for FASTENAL of $41.60, which makes it about 27% undervalued. So that's not great. And now moving on to the multiples valuation, this looks a bit better, guys. Using Snap-on, Stanley Black & Decker, and W.W. Grainger as our comparisons, they have an average PE ratio of 41.25, and when we multiply this by FASTENAL's earnings per share, that tells us that it has an intrinsic value of about $78 per share, which makes it about 32% undervalued. So that's quite a bit different than what we saw with the DCF calculation. And now back on the main page, if we take the average of these two calculations and apply a 10% margin of safety, that tells us that FASTENAL's intrinsic value is $53.80, which means it's undervalued by just a little bit, by about 2%. So based on this, guys, FASTENAL is still within buying range with a current share price that is just about $1 short of this intrinsic value right here. Now, having said all of this, despite not being the most discounted stocks on the market, I think these three are ones you should definitely keep your eye on. However, if you're more so looking for stocks that are coming down in share price, then check out this next video right over here, where I'm telling you about two dividend kings whose share prices have really started to come down since the start of the year. Both of them are currently priced near my average cost per share, so I am loading up on them while I can, and I'm telling you all about it. So click right over here, and I'll see you in the next one.